Thank you everyone for joining us for a program on the basics of financial management. Our presenter today is Amina Abdul Malik, who is a business counselor with the St. Louis Small Business Development Center. She is the presenter of this program and will also be available for questions afterwards because she does one-on-one counseling. Her focuses are on startup services and business plan development. This recording has begun, and all of you attending today, as well as anyone else who finds the library's YouTube channel, will get the recording. I'll be emailing it if you are here. And with that, I will just turn it over to Amina.
Thank you so much, as always, Eleanor, and thank you for being the great partner to bring us together today for today's presentation on understanding financial statements and the basics of financial management for your small business. So thank you all for joining us after our tech issues. Once we conquer one tech challenge, there seems to be another one that gets uncovered. So thank you all so much for joining. Eleanor already gave an excellent introduction for me. I know we're running a little bit behind on time now, and there is a bunch of information that we're going to get through within this presentation. So I like to save the introductions for the chat, but I would love to learn a little bit more about you all in the chat. So if you want to put in the chat your name, let me know a little bit about your business that you have, what stage of the business you're on, and how do you feel right now about your understanding of the basic financial statements right now. So if you all wouldn't mind putting that information in the chat, I would love to hear from you all as we kind of go through this presentation. But Eleanor already spoke about my background. I am a small business development counselor for the St. Louis Small Business Development Center. Has anyone ever, and feel free to come off of mute or type in the chat as well, has anyone ever heard of the SBDC before or is familiar with SBDC services? Okay, so I don't know if I'm pronouncing this correctly, Tavana or Tavana, you can come off of mute and correct me as well, but I see that you say, what were you going to say? Oh, I saw you, it came off of mute there.
Oh yeah, sorry. No, yes, I've heard of it before. I know about it. I haven't used their services yet, but I do know about it, yeah.
Well, this is your first use of our services, but if you're not familiar with the SBDC, we're a nationwide network of support for entrepreneurs. We provide no-cost counseling and training to our clients who are looking to either start or grow an existing business. So my areas of expertise, I work with a lot of our startup clients on things like registration, business plan development, preparing financial projections and financial statements, getting your business bank ready to access capital, preparing marketing plans and strategies, talking about understanding your inventory management, your pricing strategy. But our counseling team works with all different types of business owners across several different industries. If you're already in the growth stage, we can help you come up with a 5-year growth plan. Even if you're thinking about closing your business, we help and assist with succession planning. So the SBDC, we're a support organization, and we also work with a lot of the other entrepreneur support organizations here locally, and obviously on a federal level. The SBDC program is actually facilitated by the SBA, which is that federal government entity. So that's just a little bit about the SBDC. As Eleanor mentioned, we do offer one-on-one counseling. So a lot of this information that is in this presentation, you'll want to kind of take back with you. You'll want to take back with you into your business and start to put together some of these financial statements or even projections if you're a startup. And in order to do that, the SBDC, myself and my team, we have access to a bunch of different spreadsheets and tools to help aid you in preparing these different financial statements. So that's definitely something we can talk about after class and set up a counseling session for. But let's jump into the objectives for today. Today, you all will be learning about the three different key financial statements that your small business needs to understand to be successful. So we'll talk and learn about the profit and loss statement as well as the balance sheet. And we're not really going to talk about the third statement that much in this presentation, but the third key financial statement is the cash flow statement as well. But today we're going to focus on the profit and loss statement as well as the balance sheet. You're also going to learn about how to use key financial ratios. First, you're going to learn about what a key financial ratio is and why financial ratios are important to your business. And then we're going to learn about some of the equations for some of the more popular or more important financial ratios. Oh, so we talked a little bit about the agenda. We're going to jump into this first topic. As I stated, this presentation really could be a 3-part class. It could be longer. So there's a lot of information I'm going to try to get through today. But we're first going to start by taking a look at your profit and loss statement and your balance sheet. Then we're going to kind of take a look at the different types of accounting systems. We have the cash accounting system and accrual. And then we're going to briefly look at a case study and then wrap up with understanding and learning about those financial ratios. So when you're thinking about your small business has many different places where it's going to get financial information from. The first place is going to be the chart of accounts. The chart of accounts on a base level is just where you're going to describe the different types of accounts your business has. So let's say if you're a consulting business, your accounts are going to be a little bit different than a product-based business. If you are a service and you're a consultant, you're not going to have an inventory account, are you? The product-based business will have that type of account. So the chart of accounts basically just defines what different types of accounts are going to be included in your general ledger. And your general ledger is really where you summarize all of the different financial transactions that your business has in a specific time period. So when you're looking at a general ledger, every transaction, whether it be a sale that you make or an addition of revenue or something you spend money on or an expense or payroll, all of your financial transactions are grouped by account in your general ledger. And then finally, once you have your general ledger and you have that summary of all of your different transactions, no matter what type of transactions they were, then you're going to be able to come up with your different financial statements and garner information from these different pieces of financial information. So we'll be able to come up with your profit and loss statement, your balance sheet, those financial ratios, and even your cash flow statement, which we talked about. So when we look at the general ledger, we know that it connects everything. The general ledger is where we put all of the information, and then we pull information from that general ledger into these different detailed sources. But now let's take a look at the actual financial management cycle. And let's say that there's really, it's in a cycle. So if we take a look at a startup business, you're most likely going to be starting off by predicting your future performance. So how many of you all right now are in what you would consider the startup phase? Or let me ask you all this. How many of you all have already created financial projections or are using financial statements in your business right now? And if you're not already using these financial statements in your business, or if you are a startup, okay, so you're starting over, so you're in the position now to where you're preparing all the information to be able to predict your future performance. So that's a great place to be. But if you're in the startup phase, or even if you are in business and haven't prepared these type of statements before, you will start by predicting your future performance. And that starts with coming up with the budget, understanding what value you are trying to provide to your customers, how much is that value going to cost you to provide, and creating a feasible budget for providing that promise to your customers or that value. And then it also includes coming up with a pro forma statement. A pro forma statement, you can think of that term as a projection. So that's the same thing, just a different term. So you may hear the term financial projections, or you may hear the term pro forma statements. The pro forma statement is just a projection of the future. So you start off by doing predictions. And we will talk a little bit more about how to create those predictions. Then your business does work. It performs, either it provides that, yes, pro forma is the term. Is the term, Tavana, I'm sorry. So after you've created your cash budget, you have created your pro forma statements or your financial projections, then you're able to actually go out and do the work. You're able to go out and provide the value to your customers, and then you will be able to come back and document that past performance. Your past performance is going to be documented by looking and having access to those financial statements. So that profit and loss statement and that balance sheet. So what you'll be doing at this point is comparing your pro forma financial statement to your real life profit and loss statement and balance sheet. And that is the whole purpose of your projections. Well, one of the purposes of your financial projections is to be able to then compare and to test to see if you are meeting up and living up to your financial expectations for the business. Then that leads us into the last step of the cycle, which is analyzing that past performance. So once you have access to your profit and loss statement and balance sheet, which if you're using any of the financial management software tools like QuickBooks, they will all automatically create these statements for you. So once you get these statements, you're able to analyze your past performance by using financial ratios and also by analyzing your statement of cash flow. So as you can see, this cycle is always moving, and in most cases for your small business, you may be blending or operating in different parts of the cycle, and some of those parts may blend in terms of time. So right now, if you are already in business, you're always going to be documenting your past performance, but you're still going to be consciously also predicting for the future as well. So you're constantly going to be moving through this cycle as a business owner. And so you want to be aware and as comfortable as you can be with these different financial statements. So the two statements that we're really going to be talking about today are that profit and loss and the balance sheet. The profit and loss is probably my favorite financial statement, and that's because it is a summary of the money you are making from your business. So the profit and loss statement is going to summarize your company's sales or revenue, your company's expenses, and ultimately it's going to show you your profit or loss from your company, hopefully profit. You may hear a profit and loss statement be called an income statement, and that's because ultimately it shows the income or the profit or loss from your business. The balance sheet is also very, very important, and this kind of gets into the financial health of the company overall, because the balance sheet will show you everything that your company owns and everything that your company owes, as well as what your company, what you as the owner has put into the company at a certain moment in time. So the profit and loss statement is showing you everything that your company has made or earned, everything your company sold, or how much your company made versus how much your company spent over a period of time, versus the balance sheet shows you everything your company owns and everything your company owes at a moment in time. So those are kind of the biggest differences between the two. However, as they say here on the slide, both of these are going to be documenting past performance. But when you are creating pro forma statements or financial projections, we are creating those statements and projecting for those statements. So here's an example I wanted to show of a profit and loss statement for a company called Computer Solutions. And if you look at the top of any profit and loss statement, you will see a description of the income of the company, and that's why it's called the income statement. It shows you everything your company made over that period of time, from January through December, and it looks like back in 2004. So if you get into, you see in this example, the net sales number is just one line, $628,000 here. However, when you start to go into detail and we're creating these statements for your company, we're going to go into even more detail than that. In order to get this net sales number, you have to go through each of your different revenue streams and estimate how much you expect to make for each of those different revenue streams before you're able to just come up with a net sales number. But that's something that we would work through, and that's definitely something that I can assist with, is helping you come up with a feasible revenue projection and how you come about that. But you see that at the top part of your profit and loss statement, you're going to be describing your income or everything that your business made. If you are selling a product, you have the cost of goods sold line here. The cost of goods sold line is everything that it costs, or every component that it takes for you to actually provide that product. So that includes the actual tangible materials if you're manufacturing something, the packaging that belongs with it, everything that it takes to actually create that good or that product goes into cost of goods sold. If you're a consultant or you're selling a service, you're not going to have cost of goods sold. However, most businesses, well, all businesses, are going to have some type of expenses, which is the second component of your profit and loss statement. So after you've described the income or sales or revenue, all of those terms are kind of mostly interchangeable here on this statement. You can say sales or revenue. You have your total income. You'll subtract the cost of goods sold from that, and that's what it took to make that product, if you have a product, and then you have your gross profit. Once your gross profit exists, your gross is that number that exists before you start taking out all of those extra variables from that number. That's your base. Every business has expenses. If you look at this list of expense categories, every business industry won't use the same expense categories. Let's say, for instance, a good example here, repairs and maintenance. If you are a consultant that does business consulting or financial consulting, you're probably not going to have anything in that repairs and maintenance line for your expenses. But it's important to make sure that when you're creating your profit and loss statement, that you are mentioning and reporting all of the relevant expenses that you can expect, or everything that you can expect to have to pay for to provide that product or service consistently. And expenses are not directly related to your sales. So expenses are those reoccurring costs that aren't directly related to how much you're selling. So if you sign a lease, you're going to have to pay that rent regardless of if you have $10 in sales or $628,000. So expenses are those things we want to try to estimate accurately, because it doesn't matter how much your company does in sales if those as those expenses exist, or in relation to those expenses. After you calculate your expenses, you're able to come up with your net ordinary income. And I always I think of gross and net. The net is what's captured after everything else is dropped out and all of those different other components have been eliminated, and that's what you have left. The gross is just everything thrown at you at the wall. So you start with the gross, eliminate the expenses. Really, you would also take out things called depreciation, your interest if you have a loan or you bought equipment and you're paying interest on that. And then after you subtract all of those other components, you are left with your profit or loss. Hopefully, you are left with a net income like Computer Solutions, who had a net income of $15,000. But you could also have a net loss, which would be a negative number there, which indicates that you are either not making enough money from sales or you are spending too much in expenses. But it really could mean a lot of different things. It could mean that you are spending too much on your cost of goods sold. But having your statement prepared is going to be the first step for you to even be able to analyze and use those statements to figure out what could be changed with the financial structure of your company. And the income statement is going to be required for tax purposes. And ultimately, as I stated here, it is going to show your income. I think they are just going through some of the examples here. I talked about this already. The net sales that you have minus your cost of goods sold equals your gross profit. Cost of goods sold is strictly related to you providing a good, actual product, so you don't have to worry about this for a service business. And then there are going to be different expenses based on the different type of business you are operating. And then if you are borrowing money, that interest expense is included as something that comes out of your profit for the year. And that obviously makes sense because you have to account for the interest you're paying on that loan. And so it's not a part of your net income for that year. And then finally, we talked about the net income number. Hopefully this number will always be a profit, but this is what you have left after you deduct all of the costs of you doing business. Now, any questions about that profit and loss statement before I move over to the balance sheet? Okay. So on the balance sheet is really showing you at a moment in time. So for Computer Solutions, it's showing where this business stands on December 31st. And the first half of the balance sheet is going to always describe and show the assets, everything that the business owns. When you're reading a balance sheet, the balance sheet will always be ordered in terms of liquidity. Liquidity is one of those hot button business terms. And what liquidity means is how quickly and easily an asset can be converted to cash. So when you are organizing your assets in your balance sheet, or just thinking about your assets in general, your first asset is always going to be cash, or those current assets. Cash is the most liquid asset. You have your checking and savings account, you have your accounts receivable. Accounts receivable is the account that exists for any money that your business expects to receive in 30 days. So if you were a service-based business, accounts receivable is where that money sits on your balance sheet when you have billed a client, but you're waiting to actually receive payment. So as a consultant or a service-based company, you really have to be careful about keeping your accounts receivable current and making sure that you are collecting payment within 30 days or less, so that that money gets out of accounts receivable and can be put into cash or can be put into another asset. So once you get past the current assets, you also have your fixed assets. And those are those assets that are not as liquid and cannot be quickly and easily converted to cash. And those fixed assets typically include things like machinery, equipment, a vehicle. If you were, if you bought a building, any of those types of longer term assets will be in that fixed assets section. Your total assets number here is amounts to the amount of your current and your long-term fixed assets. And then you see at the bottom here, you have liabilities and equity. Liabilities is showing you everything that your company owes at this moment in time. Just like assets, your liabilities are also going to be ordered in terms of liquidity. So just like you have that accounts receivable account where money that you're expected to receive in 30 days sits, you have your accounts payable account. That's for money that you're expected to pay out in 30 days sits. So, and then you also have your longer term liabilities, such as a bank loan or any debt, any of those longer term purchases or contracts or obligations that your business has financially will be included here. So when you add up all of your liabilities, the last component of that balance sheet is equity. Equity is is what you as the owner have put into your company. And so equity is really going to be what your claim can be against the business's assets. So in this case, in this example for computer solutions, if we look at the equity section, the owner's draws you see is a negative number. Owner's draws is negative $14,000 or $14,000. That's because an owner's draw, if you own and operate an LLC, is how you pay yourself versus putting yourself onto payroll. So if you ever see or you're trying to figure out or indicate what an owner's draw is, that's money that the owners took out from the company and to pay themselves. So that's how you pay yourself if you were the owner of an LLC, is through an owner's draw. The paid-in capital is what you as the owner contributed to this business, okay, or have injected into the business as equity. So if you're a startup and we're coming up with your pro forma or your balance sheet projection, we are going to indicate in there that, let's say if you have $5,000 that you're inputting or injecting into the business as equity, we will put that $5,000 in the paid-in capital section. The retained earnings is any money that the company made that was net income that the owner decided to put back into the company. So retained earnings is money that came to that made it out of the company as income that is being retained and put back into the company as retained earnings. So that is kind of how you are supposed to, from a financial perspective, display you putting money back in is through retained earnings. And then finally, we have the net income line here, and then we have the total equity, which is the total of the owner's claim against the business. One important thing to note about the balance sheet is that the number or your total assets, which you see here for computer solutions, is $233,930, will always equal your total liabilities in equity. And there is a pretty simple and great reason for this. So if you're creating your balance sheet, it's all said and done, and your assets are not the same number as your total liabilities in equity, something is off. And that's because everything that your business owns is either funded through liabilities, which is debt, a bank loan, or through owner's equity, something that you put into the company, or something that another person has injected into the company. So your assets will always equal your liabilities and your equity. Does anybody have any questions so far as we wrap up this section about the profit and loss and balance sheet? All righty. So let's talk briefly about the two different major types of accounting systems. We have two major types of accounting systems here in the U.S. that are recognized by the IRS, and those are the cash accounting system and the accrual accounting system. When you think about cash accounting is very simple. You record the value of a transaction when cash flows in or out of that business. So if you hand someone the cash, no matter if they receive the product in, no matter if there's other components of that transaction, you're recording that transaction as at the time that it occurs. Accrual accounting is a little bit different because it records the value of the transaction at the time that it occurs, at the time of the transaction, but not necessarily when the cash is transferred. So let me try to make this a little bit more simple. If you're using the cash accounting system, as soon as cash, whether that's a credit card, debit card, as soon as payment is exchanged, the transaction is recorded. With accrual accounting, as soon as the transaction is scheduled and confirmed, the transaction is recorded, not necessarily when the cash is, when the payment is submitted. And so cash accounting is really for that perfect world scenario where you're getting supplies, you're paying for the supplies, You're then creating your item or creating your service, selling your item or service, and then finally getting paid for that item, all in the same time frame. So in a perfect world, cash accounting works. But we know all about the different variables in a transaction. Accrual accounting means that revenue and expenses are recognized and recorded when they occur. And while the cash basis accounting means that these line items aren't really going to be documented until that cash exchanges hands. So that really means that the cash accounting system is easier, but accrual accounting portrays a much more accurate portrait of a company's health because it includes those accounts payable and accounts receivable accounts. So if you're using cash accounting, you really don't have a need for accounts receivable and accounts payable. But realistically, the cash accounting system is a little bit limited in the types of transactions it can describe. So accrual accounting is the most commonly used method for larger companies because it smooths out your earnings over time. And typically, we're going to recommend that you do use the accrual accounting method, especially if you're selling a product versus a service. But the cash accounting method is an acceptable accounting method if you are operating with a simple sales plan or a simple pricing structure. And that's also something that we can do a little bit more of an analysis about if we do set up a one-on-one session and you all want to kind of learn a little bit more about how to select an accounting system and start putting together some of these different financial statements. So just looking at this Computer Solutions profit and loss statement, this income statement is really showing you and giving an indication of how your business is doing. It tells you how profitable a business is over a given time period. So in this year of 2004, Computer Solutions profited $15,000. That's after expenses. And the income statement can really be used to make better decisions on how to price things. If your expenses aren't extremely high, but you feel like your net sales number is not what you projected it to be, then it may be a good time to look at how you're pricing your items or your services. Is there an opportunity to change the pricing strategy that would improve your revenue or sales? The profit and loss statement can also help you do a better job with making decisions on margin maintenance and expense control. If you're looking at your list of expenses, and I'll explain how in just a moment here, but if you're looking at your expenses, you're better able to determine where you're spending the majority of your the money expense-wise, to maybe make changes and figure out if there are ways to potentially decrease those expenses, like the advertising being $12,000. What are we spending this $12,000 on in relation to advertising? And is there a better utilization or a better strategy that we can come up with advertising that would maybe save us dollars? Now, it's a little bit tricky to determine how heavy or how important these different expense categories are in relation to your revenue if you don't have any way to add scale to these different numbers. And that is where something called a common size statement comes in. And a common size statement, it converts your different accounts on your balance sheet and your profit and loss statement to a percentage. And that's also can be called a percentage size statement. And your common size statements are used to compare current periods with previous ones. So they're very, very helpful for you to do historical comparisons for your data. Also can be used to compare your business to ones that are of a similar size in your industry. And let me show you why these common size statements are very, very helpful. Because when you look at this profit and loss comparison document here, it's comparing profit and loss statements for 4 years for Computer Solutions. When I immediately look at this, my brain starts to hurt. There's a bunch of numbers here, and it is easy for me to get overwhelmed by looking at this. But the common size statements make this a little bit easier to read. if we look at the common size statements, all of these percentages are how much this account or how much these accounts are in relation to your net income. So if we look at the cost of goods sold for the first line here, January through December of 2004, we see that in 2004, the cost of goods sold, I have to move my chat a little bit, 1 second, was $364,511. It was 58% of Computer Solutions income. So 58% of their income, which this sometimes happens, it often happens with product-based companies, 50% of their net income is going to actually producing that product, okay? And I will say, if you all are product-based businesses, cost of goods sold is something you're constantly going to be managing, trying to improve, because that can really derail your profit margins if you're not having the lowest possible cost of goods sold. But you can see that 58% is a little high. You really want, obviously, your cost of goods sold to be as low as possible, but somewhere between 20 to 40% is a little bit more reasonable than it being more than half of what you're making back after all of these expenses. But there are some improvements that are made year to year. Or excuse me, I'm actually going the opposite direction here, and they actually had an increased cost of goods sold year over year. So they are not improving their cost of goods sold. And you can see that year over year, the revenue, the net sales, which is that first line that you see, it increases from 2001 to 2 to 3 to 4. It starts off at 395,000, and in 2004, they were able to have a sales of over 600,000. In the same token, it's also reflected in their total cost of goods sold. You see that their cost of goods sold started off as being only 53% of their income. And when it's all said and done, as the revenue has increased, the cost of goods sold has increased as well. So one of their focuses probably can be to take a look at their cost of goods sold, and as they are selling more, figure out ways to build more efficiency to be able to still maintain that 53% cost of goods sold. So the common size statements are helpful to kind of give us indicators of what these numbers mean. So we see that if we look at the expenses, one positive here is they've been spending more on making their product, but if we look at their total expenses year over year, they started off, the total expenses used to be 47% of their total income, and then overall they were able to decrease their total expenses all the way down to 39%. Now, if we dive into the expenses, we see here that none of these percentages are extremely high, but we can look and see what the changes between some of these percentages are. Was there a huge increase in the amount of dollars spent on advertising year over year that needs to be adjusted or taken a look at? Overall, using the common size statements will make your analysis a lot easier versus you trying to compare year to year with just the statements themselves. Any questions about the common size statements at all? Okay. And this is just kind of wrapping up this example here and wrapping up this case study about computer solutions. We already learned that the balance sheet is going to give you a snapshot of your business's financial health at a specific moment or point in time. We talked about liquidity. So your balance sheet it almost provides a book value for your company or a valuation for your company in some capacity. And the thing about the balance sheet, and you notice when we started this, I prefer or I enjoy the income statement or profit and loss statement a little bit more than the balance sheet, but all of these different statements are equally important. But the balance sheet sometimes needs to be analyzed a little bit more because since it's at an exact moment in time, it can sometimes not reflect actual value. So let's say you just completed a huge project or computer solutions did, and you are waiting for a $100,000 payment from your client for that project. That and this is the same case with computer solutions. They have $106 in accounts receivable right now. That is money that they will receive into their cash balance, and that will be converted to cash in 30 days or less. So if someone's looking at their balance sheet now, this company doesn't look very liquid because they only have $4,000 available in cash. That's because they're waiting to receive that payment. So if someone's looking at this statement, I would think to myself, if I'm a banker, a lender, someone wanting to provide money to this company, capital, I'm a little bit wary because it doesn't look like they're able to, it doesn't look like the company is very, very liquid. Next month, if they are able to successfully collect payment and keep their accounts receivable up to date, this $1,600 will move over to cash. Then if I'm a banker, that makes that company look a lot more liquid and able to cover its short-term obligations. So the balance sheet is very, very important for a lender to look at, because it really will let the lender know how liquid your company is, or how able you'll be able to be to cover your short-term debt. We talked about this equation already, that assets equal liabilities plus equity. And we said that is because anything that your company has as an asset, whether that be cash, inventory, the land that you purchased, it was either paid for by a loan, a mortgage, some type of debt, or through owner's investment into the company and profits from that company being put back in. If you are looking for resources to try to help prepare financial projections, maybe do some market research to understand, to help you come up with estimates for your expenses and your revenue, to try to maybe compare and get access to industry benchmark data, there is a lot of different resources for that. The first I'll mention is the Public Library at Eleanor and her team. They have access to a bunch of different databases and platforms to help prepare financial statements and get access to information and industry information, so you can see what other businesses may be making and spending as well. And then also the SBDC, my team here at the St. Louis SBDC, we have access to a bunch of different templates, resources as well, to help you understand how to create these financial statements that are actually feasible and based on actual industry information and comparisons. We are going to wrap up today with learning about financial ratios and how we can use financial ratios in your business to make better financial decisions. So we learned about the different parts of the financial management cycle, and we talked about predicting, and we talked about the two different statements that are going to help you document your past performance. But now let's dive into the analysis. How do we use these statements to make better decisions and gain information about our companies? So ratios are going to be used to compare your current performance to previous years. They are also going to be used to compare your current performance to other businesses in your industry. And then you're also going to use your ratios to compare to your own plans. Are you living up to your expectations financially for your company? Also, ratios are used by bankers to determine different lending ramifications or standards. So on a base level, when you provide your business plan, which includes your financial projections to the bank, if you are a startup, they are going to run those numbers and come up with financial ratios based on the pro forma statements that you provide to start to do some analysis. So let's talk about a few of the more important financial ratios. So most ratios are going to be set up as a basic equation. So this is kind of an example of how we're going to have a ratio set up. And the first ratio we'll look at is the debt to equity ratio. So debt to equity is really, it describes what percent of assets your business has that are financed through debt versus what percentage of your assets are financed through owner's equity or money that you put into the company. And in order to calculate this, you divide your equity, your total equity from your liabilities here, and that will give you your debt to equity ratio. So typically a higher debt to equity ratio means that your business is very, very risky. And that is because your business is highly leveraged on its liabilities and not the equity that you have put into the company. So to a lender, that adds risk. If your debt to equity ratio is low or extremely low, that means that your business is almost too safe. There's not enough risk to equate the return there. So there's not enough reason for a banker or a lender to lend you money if you already have a high amount of equity leveraged into your business versus liabilities. So there is a balance and a spectrum for these ratios, but generally a good debt to equity ratio is anything lower than 1. A ratio of 2 or higher for debt to equity is usually considered too risky. So for Computer Solutions here, for this example, they're edging on that risky bar. And if the debt to equity ratio is negative, then that means that the company has more liabilities than assets even, and that means that the company is extremely risky. So a negative debt to equity ratio typically is an indicator of bankruptcy. Current ratio, one of my favorites, because this gets into liquidity again. And we know that liquidity is how able your business is to cover its short-term financial obligations. So when we're analyzing liquidity, or excuse me, the current ratio is really the percent of current assets versus the percent of current liabilities. So this ratio is a great indicator of your business's liquidity. And if we look at this equation here, we're just simply dividing the current liabilities from the current assets. And you see that is what makes this ratio all about your short-term financial obligations. And when we think about the current ratios and what's good and bad, if your current ratio is high, that means typically that there's not enough long-term assets connected to your company, and you are very, very highly liquid, which is good to have liquidity, but you also want to balance that with long-term assets as well on your balance sheet. And so if your current ratio is extremely low on the opposite end, you don't have enough liquid assets to cover your liabilities. And that doesn't mean that you don't have any assets to cover your liabilities. It just means that you don't have enough liquid assets. So if you purchase a building and you purchase a vehicle, those assets are still very, very valuable to your company, but they're not going to be valuable if you need to quickly convert something to cash. And so that's all this current ratio is about. And typically a good current ratio for most industries is going to be 1.2 to 2, which means that if you have 2, your business has 2 times more current assets than liabilities to cover your debts. And so that's a good place to be. The quick ratio. The quick ratio is similar to the current ratio, but it involves the percent of assets that can quickly be converted to cash, but it eliminates inventory from this. So if you are a product-based company, a quick ratio gives a lender a good indication of how able or how leveraged your business is on inventory. It takes the current assets, subtracting the inventory, and then divides the current liabilities by those to get that equation, to get that number there. So a good quick ratio is typically anything greater than 1. If your business has a quick ratio that's greater than 1, that typically means your business is healthy and can pay off its liabilities. The greater the number, the better off your business typically is in this regard. But a high quick ratio means that your business is very, very financial in the short-term future. It means your business has good growth in sales. You're collecting on your accounts receivable. So ultimately, the quick ratio is one of those things where the number, a high number, is typically a good thing. But you want to be careful with that high number because if you do have a high number, it could mean that you are not reinvesting properly into inventory and allocating your assets in the right way for growth. So a high number is good, but it may mean if you're a product-based business, you're not putting enough back into your inventory. But if you have a low quick ratio, that means that you have a shortage of cash. It's very, very concerning because it means that, like, once again, you have fewer liquid assets than liabilities, and that's even without the inventory being included in it. And so if you have a low quick ratio and you are a product-based business, then that may mean that your inventory management needs to be adjusted. And so there are a lot of different ways we're able to use these ratios. The main things I want you to take from this are the actual equations for the ratios so that you can start to prepare, as you prepare your pro forma, financial projections, your financial statements, we can use these ratios to come up with ratio projections as well. The days receivable ratio, this is all about how quickly, on average, you are collecting payment from your customers. And we, as I described before, if you're not collecting your payment within 30 days or less, then you are putting your business in a position to have cash flow problems. A high days receivable ratio shows that a company is selling its product to customers on credit and waiting a long time to collect your money. So this equation is very, very helpful to see what maybe needs to be adapted to the sales model, the pricing strategy, or what needs to be changed if it is too high in order to make sure that you are collecting payment on time. But one of the major things that happens to construction companies and consulting businesses is not managing accounts receivable and then having cash flow problems to where you're not able to start a new project because you're still waiting on payment from another one. So coming up and making sure your days receivable ratio is healthy is important to service-based companies. The days payable ratio is the average number of days you take to pay suppliers. If you are a company who is selling a product or good, if you have a higher days payable ratio, it's taking you longer to pay your bills, but you are holding on to your money a little bit longer. So it's taking you longer to pay your bills, but it means that you are able to retain those available funds for a longer duration, which gives your business the opportunity to utilize those funds in a better way to maximize the benefits. But so it all depends on who's looking at these ratios and using these too. If a lender sees you have a high DPO or days payable ratio, that may be a red flag for them, which may indicate that you have an inability to pay your bills on time. Now, you as a business owner, if you have a somewhat high DPO, you can take that information and try to utilize it to understand, well, if this is my average days payable, I know I'm typically going to pay with, probably 45 days out for my bills. What can I do at that 30-day mark if I'm not paying the bill on time, what are you doing at that 30-day mark with those funds that helps and improves the health of your business? And then finally, the inventory turnover ratio is the number of times your inventory turns over or gets repurchased over in the course of a year. And that equation is just you taking your cost of goods sold and dividing your inventory from that. And if you have a high inventory turnover ratio, then you are moving your inventory very quickly, but that also probably means you don't have a lot of inventory on hand. So a high ratio for this, if you are selling a product, you may want to take a look at, are you able to always have access to your inventory? Are you selling out at any time? And there may adjustments need to be made to how much inventory you keep. And if your inventory turnover ratio is low, then you may be not selling something. You maybe need to make changes to your marketing plan, but for some reason, you're moving through that inventory slowly. And I missed one. I said that the inventory was the last one. This is the real last one, the return on equity. And this one, I won't spend too much time on it, but what this one shows is how it's really going to be how much you are profiting in comparison to your investment, or how much you're spending in relation to the amount of money you put in. So this is a very, very helpful ratio to kind of understand your return on your investment as the business owner, because it's basically describing what amount of return your investment is getting back in terms of a percentage. So if you have a high return to equity ratio, you are receiving good profits in compared to your investment financially to the company. Or it could also mean that your business is highly, highly leveraged just on your equity. So if you put $5,000 into the business and your business has only made or hasn't made any money yet, yes, the business is very, very highly leveraged on your equity. If the return on equity ratio is low, you're not profiting enough, you're maintaining too much equity. So it's all about balancing the amount you're putting in with how much you're expecting to make. And so all of these ratios, the theme here, and what all of this means is these are all tools that you take into your business to be able to make better decisions. And I would love to speak with you all further about creating these statements. If you have any questions or want to work on coming up with your financial statements, your financial ratios, coming up with revenue projections, or talking about what different relevant expense categories there are, I am definitely available for counseling. Today, we talked about these different topics here. We learned about the key financial statements, your balance sheet, your profit and loss. We talked about that cash accounting system versus the accrual accounting system. We learned about computer solutions and actually got to take a look at some example financial statements, and then wrapped it up and learned a little bit about financial ratios. I thank you all so much for participating in coming to the webinar today after our tech issues. But I think I'm wrapped up for today. And were there any questions for me?
No, thank you so much.
It is my pleasure. And I believe I have your email addresses. I would love to, I will be going ahead and sharing the slides for you all. But I know that Eleanor also has a recording that will be processed and sent out too as well. So thank you all so much for joining.
I do have a good question.
Sorry.
Sure.
Sorry, I don't know if I missed that part. What are the fees to meet with somebody to like make
This is no cost.
Oh, okay. Okay,
Yep.
cool.
Yep. So this is the SBDCs are a program that's facilitated and really funded through the SBA, which is that federal government entity that exists to help entrepreneurs and small businesses. So you don't have to pay for counseling services.
Awesome. One more question. Do you all help, I'm just wondering, do you all help small businesses find various types of grants? Business grants?
You know, I'll be honest with you, that's a hot button question for us. And typically we do not. And what I will say is, what I can do is refer you to a bunch of places that can help you with grant searching. Eleanor can also give you some recommendations. They have some databases for grants, for finding grants. I'll be honest with you and say that in my 5 years as a business counselor, we get asked about grants so often, and realistically, we don't see a lot of our clients get access to grant funding with traditional businesses, for-profit businesses. And as you know, grants are typically going to be for something philanthropic, a social justice issue, something with the environment, tech, the economy. And when you do receive those grants, be aware that there is going to be activities that are required as well as reporting. But we, SBDC, it's hard for for-profit businesses to get grants, so that's not something that we really focus on, but I can definitely still give you some recommendations and resources in that direction.
I would appreciate it. I understand.
My pleasure.
Thank you so much.
Yep. No problem. And you all have a great rest of your day. Eleanor, I will talk to you soon as well. Thank you.
Super. And thank you so much, Amina. And thank you everyone for joining us for this last small business program with the St. Louis Public Library for 2021. Amina and I are already working on programs for 2022, and we hope that we see you at some of those.